sort of the scene of the crime, if you like, in terms of Jorge Montague, president and founder of Global Markets, the last one to turn off the lights in Singapore this week. Jorge, are we going to return to planet Earth once everybody wakes up and remembers that every barrel that Saudi cuts is an idle barrel of capacity, and now they have 2.5 million barrels of idle capacity? What's all the fuss about?
Well, first of all, hello to everybody. And Sean, great to see you. It's great being here in Singapore and getting a sense of the market. So let me share some of the highlights. Number one, the Chinese are everywhere. So if you see the attendance is heavily, overwhelmingly Chinese. The role of the Westerner, or Angmo as they call it here, is definitely sunsetting, if I may misuse that word. In years past, it was definitely the other way around. And there was some very serious, heavy politics going on. There are market things, but there are greater political things. And I'm going to be, as per normal, very open and honest in my views, in what I have seen and how I have, in a way, validated that in various conversations. And number one is that there is a low to medium level rift between the US and Saudi Arabia. And there is a medium to high rift, or medium to, or high to extremely high rift between the US and Russia. There's a fight of various levels within those two countries. And in the discussions I have been having with various market observers, producers, major Western oil companies, is how can you, meaning US, win a battle against 20% of the world oil supply, which Russia and Saudi Arabia are? And if we're very honest in that assessment, is you have no chance. Really, you have no chance. You have to be very fair and say you have no chance. And if you extend that battle to Iran, Venezuela, and maybe you know, well, you must know, you do know about the delegation coming in from the US to the UAE this week to tell them, don't do that, meaning don't sell to Russia. That 20% starts to grow massively, right? 25, 30%. You cannot win. And what we have seen in the OPEC and among this OPEC Plus is that they do have not full 100% discipline, but some level of discipline. And this is evidence on the price. The price is, for all practical purposes, $90. If you add the premiums that crude commands, in effect, 90 plus at the moment. And if it were left to its pure market devices, it would be, of course, lower because there would be more supply in the marketplace. But the major oil producers are telling, in effect, to the US to back off a little. Don't push it too hard. Recognize your place in the ranking. It's better for all of us to be friends than to be fighting. The kingdom is fighting. It's the reality, right? And maybe, well, you did see that today. The Bank of China also opened a branch in the kingdom. So it's imminent that we are going to have a petro yuan. It's imminent. It's happening. We need to realize all these things. And meanwhile, the Western economies are shrinking, are suffering, mega suffering. And China as well is suffering. But at the top is, of course, Germany. And I don't know if your speakers have highlighted those issues with Germany. So from where I stand, the best thing would be to everybody have a, kumbaya, huddle up and say, let's stop fighting, and that will help the economy grow. But in the meantime, as demand drops in key centers and grows in the global south to a net effect of growth, let's not forget that there is a net effect of oil demand. Saudi Arabia Russia are willing to turn off the taps somewhat. And that will ensure that gasoline prices remain high. And just to put it here as politely as I can, remain high prior to the US election season. And they will.
That's certainly, I thought of it, a sort of a key point to end your comment on, just sort of the opening comments. Robin Mills, CEO of Camera Energy. I'm not sure I share the same drama of them versus us, with us or against us in this current profile of the market. There seems to be an appetite to jump to that place. You know, $80 to $90 oil all looks rather calm and boring with lots of idle capacity. And given the context of things, you know, no real economic recession anywhere. Your thoughts, Robin?
Yeah, I think this is not a bad price, right? The question is really where it goes from here. And, you know, Jorge mentions Germany, and certainly the German figures don't look good. You know, China is struggling, but US is still doing pretty well. And that's really the critical question, I think, for now is where does China go? You know, the Chinese oil import figures remain strong. That's probably continuing imports and going into storage and exports. So is that really indicative of the fundamental strength of the Chinese economy? You know, probably not. But still, at least for now, that those import figures do remain very strong. And this all means, you know, we have an oil price that looks, I think, $90. Everybody can be happy with it. Okay, consumers would prefer it a bit lower, and OPEC could see it a bit higher probably before they reverse their cuts. But at the moment, it's something everybody can live with.
Let's welcome our good friend Adi Imsirovic, director of Surrey Clean Energy, which is a lovely name, really. Surrey Clean Energy. Adi, your thoughts on this end of APEC week? You weren't there, I weren't there, but nonetheless, the big news of the week was the Saudi-Russian rollover, the Saudi ultimately. I mean, this is really down to two countries, isn't it? Saudi and Russia, and everybody else is just along for the ride.
Absolutely. Well, not good to be back, Sean, again. Didn't go to APEC because my daughter was just finishing university with all the celebrations going on.
Mabruk to you and her.
I was just as Jorge was going on about Chinese being everywhere, I was at University College London, and I'll tell you, it looked like it looked like Beijing University. It was fabulous to see.
Well, if I might just echo, the Chinese are all over Dubai now too, but for reasons it would appear trying to get their money out of China and into some real estate in Dubai. They're not here because they're taking in the sun.
Absolutely. Anyway, go back to business, and situation in with Saudi Arabia, Russia. Look, I don't think Russia is actually significantly cutting at all. They're just riding on the back of Saudi's decisions. Saudi Arabia, Saudi cuts are very important, but Saudi Arabia, like the rest of OPEC, in this case, it's really just pretty much Saudi Arabia, single-handedly, is always strong in a strong market, weak in a weak market. So what I'm trying to say here, the market is fundamentally strong. So that's why we are where we are, not because of Saudi cuts. In fact, I think one of the reasons why you had a bit of a correction and a bit of a wobble, but I agree with Robin, I think we'll see higher prices going forward by the end of the year before they perhaps come off next year.
But how does that coexist? Sorry to jump in, Adi. I mean, inevitably to be the devil's advocate to the bull mood this week. That, I mean, that are we just ignoring the point that that one of the points that Jorge mentioned, which is Germany, you know, basically doesn't have an economic heartbeat at the moment. China looks like it's going off some cliff or other, despite the import numbers. The US is indicating that finally the 500 basis points from the Fed is going to start kicking them in the goolies a bit. That this is not, we're not moving into a strong economic outlook period, and yet everybody's screaming $100 oil. How do those two things coexist?
Excellent point. I was just coming to that. I think I will say what I said last time I was on this program with you. I think the point is US economy is looking very robust, very strong. I think the key figures are employment figures to look at. Okay, and that may lead on to another rate increase. But the point is, if you're a fund, if you're an investor, you're looking out there, you can see the light at the end of the tunnel. You can see probably another 25 basis point increase in the rates, and probably that's it. Next year we're looking at hopefully drops in the rates and sort of better economic picture. China, again, I think China is a very difficult one. Subprime situation, it's not that bad. China is basically growing 3+%. And you know what? It's a mature economy. I don't think we can expect China to go back to like 6, 7, 8% growth anymore anyway, due to demographic as many other things as well. China has been a great importer of oil, hitting some record highs. July year on year, almost 25%. I think it's just over 23%. But that, as Robin said, when most of it went into storage, does worry me politically. I don't want to go back into politics again. I think Jorge covered a lot of that. Worries me. Why is China building up the stock? But then again, we know that China is very price sensitive. Very smart move. They were buying a lot of oil when it was cheap, and now the storage is pretty much brimming. I think they will continue to buy as long as the market stays below $90 a barrel. And again, I think I agree with the other guests. I think, you know, this is not a bad price for the economy. Germany, yes, bit of a problem. Japan is struggling a little bit. But overall, the market is not as bad. I think it's all relative to what we expected. We expected a hard landing, and we haven't seen it yet. And I think this is why investors are positive about the market.
Jorge, looking at the point you finished on, the gasoline prices in the US going into the next sort of 12 months with the presidential election, but already the current price in September appears to be at whatever 10-year highs for seasonality or something, puts it in a very high place already. I wanted to get your thoughts on how much of that is structural, not so much crude related, but ultimately refining limitations, and sort of dovetailing that with the opposite, the Chinese now importing a lot of oil, but also going to be exporting a lot of products. Where do you think products go globally from the point of view out of China, and then consequently what impact that can have on other markets like in the US?
First of all, let's put aside a little bit of the issue that there is inflation, and the inflation will continue, and therefore you will see higher prices just because of inflation.
Oil is cheap.
Let's put that aside. The issue is that the market has come back because COVID is behind us. Everybody's flying. Everybody's trying to start business. Yes, you're even more bearish than me. I think Germany has a heartbeat, very slow, but it has one. Not zero. So things have come back, and demand is very high, right? It's 103 million equivalent per year, per day this year. Very, very high. So refineries have had a great time making money because Russian oil gets knocked on the head, is a little bit cheap. They have high margins, just run. And that means they have been postponing turnarounds. And the turnaround season is finally here with us. So as the turnaround season starts coming in, that's going to further open the cracks, which means that the drivers for the price is not at the margin, it's not actually the Saudi crude cut, or extension of the crude cuts, is the absence of, at the margin, a barrel of oil. So gasoline and diesel are going to be driving this market for the next quarter. So we should expect even higher prices rising faster than crude over the next 6 weeks. And that is as we enter the winter. And I think everybody was hoping that Russia would keel over and give up. But what we are seeing is that the US is the one that gave up by buying crude for its SPR. Note that the US used the SPR to force a market change and a market concession by the Russians. It failed. The US has to buy back. So the whole environment, politically, economically because of inflation, and the demand return points to higher prices with products leading the charge.
Robin, just picking up on the Saudi piece and where and how aggressively they will be to defend price. Obviously, it would appear with these rolling cuts and extending them 3 months that that the Saudis are sort of exploring where that Goldilocks point is. It's higher than what they wanted it to be. They want the Goldilocks price to be probably where it is or higher even. How much do you think they will test that going forward? And where do you think it is that sort of goal we saw in the 2011-14 period, $100 plus, the world economy seemed to be able to absorb that in its stride. Do you think Saudi has the appetite to test those again?
Yeah, look, I was a bit surprised by the market reaction to the extension of the Saudi cuts because I thought those were obvious. I thought it was pretty clear that the Saudis were going to extend cuts to the end of the year. No surprise there. And anyway, they've allowed themselves a review, right? They can review it every month and they can get rid of the cuts. So in the way, it was kind of a nothing announcement, really. Except as a signal perhaps where their thinking is. But I think, look, you know, this kind of Goldilocks price you refer to, it's always if the price stays at $90 or $100 for a few months and everybody thinks, oh, this is okay, that becomes the new Goldilocks price. It's 110, you know, people get comfortable with a certain price quite quickly. Even when, you know, it turns out in retrospect that price, whatever it was, wasn't sustainable. I think if you know, if we were at 100 for a few months, and the world economy seems to be doing fine, the Saudis will get comfortable with that price too. And bear in mind, compared to the $100 or $110 prices of the, if you say the kind of 2011, 2013 period, you know, in inflation adjusted terms, of course, that those would be more like 130 plus today. So you know, if we're at 100, if we get to 100 so some point to this year or early next year, yeah, inflation adjusted terms, that's not particularly high by historic standards. We're only just above the long-term historical average right now.
I suppose the continuation of that point is from the historical reference. Would Saudi be willing to continue to carry the bucket beyond 1 million? I mean, they're already beyond. They're, you know, they've got 25% idle capacity, and every other OPEC plus country, bar Russia and maybe even Russia, are pumping as much as they can. Do you think they'd be willing, but bar the UAE, perhaps they're participating too in the whatever cuts they've agreed to, but the most OPEC plus countries are not participating here, and how, I'm wondering from your perspective, would Saudi be still willing to carry that bucket for everybody to keep on cutting in order to keep the price elevated, that swing producer function?
Well, I think it's important you mentioned the UAE because, you know, the UAE, as we know, has, you know, percentage-wise, has the most spare capacity of any of the OPEC plus members. And indeed, actually, this, I think yesterday, just ad hoc announced that they had indeed a higher production capacity than, I think, 4.65 million. So that they have extended their production capacity beyond where it was last year, but not able to use it. And of course, we know they put pressure on OPEC several times to get the higher quotas. So that's important because that ultimately does put pressure on the Saudis as well. If the UAE keeps arguing that, you know, we're not happy with the cuts being as deep as they are, and we'd you know, would like to increase our quota, and the Saudis at some point will obviously get uncomfortable by giving up, continue giving up quota share to the UAE. So it puts a little bit of pressure on them. But of course, the Saudis at the moment are just rolling on the voluntary cuts, and I think the sensible thing would be, so okay, it's a 1 million barrel a day voluntary cut. It's a bit of a blunt weapon, you know, 0 or 1 million. If the oil price is over $100 a barrel, let's say, you know, why not cut it back to 500,000 voluntary cuts for a while and see where that goes. So there's some more room, kind of fine tuning in this as we get into as we get towards the end of the year.
Adi, where do you think that the market is at? I mean, from the trader's point of view, is this a market to be long on? Is this a market that has a clear direction now?
I think this is a market to be long in, still stay long. All the indicators that I normally use, differentials, sort of the dated value or CFDs at the front end. Front end CFD is well over $1, so dated is over $1 over futures market that we talk about. So all the rolls, backwardation is now approaching sort of $1. We are not down in 30s, 40s, we are 70s and 80s. In the crude spreads are all indicators of a relatively strong market. As I said, it's macro picture, but also this morning, actually, I just forgot to mention the air traffic numbers came out from IATA. And in July, year on year, there was an increase in air traffic by 26%, over 26%. I think it's normally measured in I think revenue passenger kilometers. What is interesting about this very large increase year on year, 26%, is that it was this time led by international traffic. And as we know, international traffic is where you use a lot of fuel. So international traffic climbed almost 30%. So it's not the Saudi cuts. Saudi cuts certainly will help in a strong market, but it's really the strong market out there. A lot of pent-up demand after COVID, particularly the Chinese after COVID, they've had enough. And I think that demand is coming out and they're traveling and going places, as you said, Dubai, London, and everywhere else. So overall, the market, is strong for the next few months. I think I would definitely be long. Later on next year, I think it's a slightly different story. We can discuss that. I think these high prices will certainly dent demand. But I'm not so sure the Saudis are too worried about it. I think Saudis at this stage are looking at their revenues. As long as their revenues stay high, I think they'll keep the cuts on. And clearly, the new sort of management in the Saudi government is only concerned about the short-term revenue maximization, and that's all they care about. So I think they'll stick to their policies as long as they're making more money.
Let's go to the survey question, which sort of echoes my sort of tone this morning. Price will drop back towards 80 once everybody remembers there's plenty of idle capacity and all major economies are slowing down. Agree or disagree with that statement? Of course, there's no time frame on it. Drop back towards 80 when? Maybe
I think time frame is the key here, isn't it?
Yeah, it is, I suppose. Over the next quarter, I would sort of throw in there as an added sense. Jorge, I wanted to get your views on elasticity of demand, which I think is relevant now because obviously the economies are not in a trajectory that would indicate your standard global 2 million barrels a day demand increase, sort of historical average. The demand, even with the U.S. economy and the seemingly doing well, we're forever hearing we've got full unemployment, but everybody's economically miserable. There's a weird counterintuitive reality now, putting aside China, but ultimately in the G7 OECD, there's full employment in most of the OECD countries, and yet there seems to be nobody can live in the city of London because they can't afford to live there, even though they have a job. Irish people are emigrating not because they're unemployed, because they can't afford to live in Dublin. That there does seem to be this, macro numbers are relatively in a reasonable place, but the actual living crisis is there. So elasticity of demand going forward in a weaker economic outlook, 103 million barrel oil day market holds up, do you think?
Yeah, and this brings us back to the issue of inflation. We have to recognize that the price of oil cannot be low while the price of an air ticket is high, the price of rent is high, the price of eggs is high, the price of everything is high, because the whole environment is rising because of inflation. And this brings us to two very critical comments. Number one, I did speak to producers this week, and without pointing the one, they are committed to maintaining the cuts to ensure that the price remains robust. And based on my body language interpretation, they're extremely committed. Number two, the interest rates, as they have risen, they're damaging investment and economies. And in particular, let's not forget that, the already developed, established economies, because they haven't dealt with high interest rates for decades. But for the emerging world, that's every day. You know, what are interest rates in India, in South Africa, in Guatemala, Mexico, whatever? High, right? So they're a little bit higher. So at the margin, the change is not as damaging. And that means that the global south will continue to grow while the developed world gets hit. So on a numerical basis, as we enter 2024, the central bank authorities will be in a very hot seat of keeping interest rates high and seeing their economies lose their heartbeats or inflate. And the discussions we have had here in Singapore is, do you prefer to be facing an unemployed angry man that cannot buy eggs, or do you prefer to face an employed angry man with inflation that has to pay more for eggs? So the end result to us, mentally, intellectually, numerically, is that the world will be inflated next year. So as the world gets inflated, yes, the oil price, the price of products, the price of everything will go up. So I hope that kind of gives you the sense of what is coming. I think it's a very high price environment for 2024.
Robin, I wanted to get your thoughts on the earlier comment, which was the situation between Saudi and the US, and the earlier point that that was mentioned by Jorge. And of course, it's been a backdrop now for some time, particularly the relationship between the two administrations. But as we go into an election cycle, do you think there will be sensitivity in Saudi around the impact of high gasoline prices? We saw the last midterm election. It was a huge sort of issue politically. It sort of bubbled up. Going into the next cycle, do you expect Saudis to be sensitive to that or not?
Sensitive to it in the sense of trying to help out Joe Biden? No, probably not. I mean, more the other way, using it as a point of leverage, I think. You know,
but there is this backdrop security negotiation going on at the moment that we're hearing the Americans talk very openly about, the Saudi-Israel U.S. agreement that seems to be, you know, in serious discussion.
Yeah, you know, I find the U.S. pursuit of this, their determined pursuit of it, you know, a bit odd. The Saudi ask is extremely high, and I'm not really sure what the U.S. gets out of it. So, you know, even politically for Joe Biden, I'm not sure what he gets out of it, even if a rather unlikely deal does come together. So I find that a bit odd, but the US has been pursuing it quite hard. And, you know, the Saudis, of course, have some certain things they're asking for, particularly on the civilian nuclear power side, and as well on security guarantees, you know, which are pretty major asks from the US. So yeah, I think the Saudis will continue using this as gasoline prices or their influence on those as a point of leverage going to the elections for sure. But I don't really expect. I think the bridge on that deal is just too far. I don't see that the Saudis or the US will possibly be able to agree to what the Saudis are asking for.
What about Iran, Robin? I know you follow Iran closely. We saw, you know, generally speaking, Iran export as much oil as they want or can in the last this year, really. And then just last week, we saw an Iranian tanker in the South China Sea getting detained, smuggled oil, so to speak, sanction-busting Iranian oil. Where's your read on where that is, the facilitation or turning a blind eye to Iranian exports?
Yeah, the enforcement has clearly gone way down. Iranian exports have increased. A lot of that was from storage, and the Iranians kind of now reaching the limits of their output in the short term. But they could boost that further if the sanctions enforcement had weakened over a longer period. So I think it's clear that the US has made a decision. Firstly, that they want oil prices to stay moderate. Secondly, that for now that they really want to target Russia, and that they you know, Jorge reminded us they can't fight everybody at once. And it's a lot easier to say let's lower the focus on Iran. Let's talk to Venezuela, get a bit of Venezuela's not such a big threat right now. Get a bit of Venezuelan oil back on the market, and hope to hamper Russia in that. You know, particularly with rising prices, of course, the Russian discount has decreased, so Russia's kind of getting a double benefit now. I mean, higher base prices and a smaller discount. And we've seen this chat recently about the caps not really being enforced and not really being and not really being honored in compliance. So that's so there's still some desire to keep prices moderate to try to to avoid giving too much of a boost to Russia. But the US sanctions machinery does still exist, and it does still kind of act, and in a kind of like a headless chicken kind of a way. It keeps running around, and regardless of what the head should be doing. So you see things like that action.
Well, I suppose ultimately, it's if you were to pick its number one priority, Adi, it is to keep oil flowing, and on that level, it's been quite successful. The perception of slapping Russia on the wrist, but at the same token, keeping 10 million barrels of oil moving. Survey result, and Adi with the last word today, 50-50. There we go. Not such a crazy idea after all. Let's put it out there for social media comments on. But Adi, I wanted to get your thoughts on that point, Russia outlook. I mean, we are 18 months into this conflict with Moscow, with the invasion of Ukraine. Most of the Western technology and oil services companies are out of Russia. Their ability to maintain production capacity going forward, regardless of price cap and so forth. Where do you see all of that playing out over the coming quarter and next year?
Well, more of the same, Sean. Price cap never really worked, was not designed to work other than allow more Russian exports, as you rightly said, and I've been saying this all along. In terms of Russian exports, Russia will always try and appease Saudi Arabia. They want high oil prices, and Saudi Arabia is doing it single-handedly. Russia is just pretending to do bits and bobs. In fact, I think in the coming month or so, we'll see increased Russian exports, primarily because of the turnarounds in Russia. I think some 40% of Russian refining capacity will be off grid. So basically, you'll see less product, more crude, and I think they'll be struggling to place their crude. In terms of overall, your survey, I think, was excellent. It just shows how difficult the market is to predict. I think it will go higher in the short run, but the best cure for high oil prices are high oil prices. I think Exxon came out, I mean, oil is coming out of everywhere. Exxon just announced that Guyana output may reach 1 million barrels a day by 2028. So non-OPEC output is increasing. And going back to the point, very important point of price elasticity of demand, I think it works. I spoke to a few weeks ago to my helper, and she drives a car, Ultimate Economics, and I said, look, are you worried about high oil prices? She said, like, no, not at all. I said, how come? And she says, well, I use 50 quid worth of petrol every month, and that's it. So that's the ultimate price elasticity of demand for you there. So, that's what most people will do and just get on with it. And demand eventually will turn around.
And ultimately, I suppose at the moment, at least, and it says how long's a piece of string, but $90 oil isn't what $90 used to be, as we all know. Right. When we go out to buy a latte, it just about buys you a few of those. So it's not quite the full Monty, so to speak. Listen, we will leave it there. It is wonderful to have you guys back at the table. And great to end the week with the powerhouse, Adi Imsirovic, Robin Mills, and Jorge Monteagudo. Take care. We look forward to catching up with you all soon again. Oil prices trading a little bit down today, below $90 on Brent. All the best.
All the best.
Thank you.
Thank you.